Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, Head of European Rate Strategy, Blake Gwinn, Head of Front-End Rate Strategy in the Americas, and Theo Chapsalis, Head of UK Rate Strategy. Back. Happy New Year, everybody. We were all super excited for 2021, but it so far doesn't feel that different to 2020, particularly I would say on the bad news front. We've still got quite worrying COVID trends. Here in the UK, we're back in a full national lockdown. And although the US is, sort of officially now behind us, clearly political risks remain. Given I would say that over the past week, it's been US politics that's been driving markets this week. We had the Democrats winning both the Georgia runoff elections earlier this week, and Congress have now officially certified Biden's electoral victory, albeit not before protesters stormed the Capitol on Wednesday. I think we should probably start with you, Blake. We had 10-year treasuries break through a fairly significant, that 1% level earlier this week, which I guess has been fairly significant moves in the market, and that's what's been driving the rest of global markets. So what's your latest thoughts on rates markets today?
Yeah, as you mentioned, that move through 1%, was pretty notable. We haven't been through 1% since the outbreak of the pandemic, and we moved through it pretty convincingly. I'd say in the trading since the close of the Georgia elections, we have, that move has seemed to lose a little bit of steam. We've, talked to a number of accounts who had previously, before the elections, expressed buying interest in tens around the 1% level. That hasn't materialized in size, but it is notable that the kind of sell-off has slowed a little bit in more recent trading. I think most of that sell-off was really driven by expectations for increased stimulus. I think a lot of people looked at the results of the Georgia election, which will hand a trifecta to Democrats. They'll have the House, control the House, the Senate, and the White House now. Looked at that and said, okay, we can really expect some more significant COVID relief or stimulus coming down the pikes, likely Q1, Q2. If you've listened to the podcast before, you're probably going to guess I'm a little bit more pessimistic on that front. There's, I think, some important dynamics there that a lot of people are kind of glancing over. I think what the markets have done in some respect is basically look at the results of Georgia and say this is a delivery of the kind of blue wave that everybody was talking about back in November. And if you remember at the time, a lot of people, including ourselves, were expecting, a very strong performance from Democrats in November that would basically give them this big mandate to come in and do a lot of spending, a lot of not just COVID relief, but stimulus and infrastructure spending further down the line. Obviously, that didn't materialize, and I think for a lot of market participants, they looked at the results of the Georgia election and said, okay, this kind of is a continuation of that theme. I don't really see that as the case. Back then we were really thinking that, as I mentioned, there would be this big mandate, a clear mandate coming in to deliver on a lot of their legislative priorities, but also we had expected Democrats to have a stronger lead in the Senate, such that they could have ended the filibuster, which in the US, if you remember, filibuster rule is something that can be deployed in the Senate. Instead of a simple majority, bills essentially have to pass with a 60-vote majority. If they had had a big lead in the Senate, they would have been able to end that rule. But as it stands, with just a 50-50 split, Democrats do not have the vote to do away with that rule. And so what that means is that basically any type of big package they do is going to have to likely raise 60 votes, not a simple 51 to get passed. So that really limits a lot of the things in my mind that they're going to be able to do. They have a few options. They can do this process we call reconciliation here. It's this really quirky rule that allows for certain types of bills to be passed with a simple majority, but you can really only do one of those a year. And also there's all kinds of restrictions on how you can pass those bills. Most importantly, they have to be budget neutral along several different respects, which means you have to add some kind of revenue raisers to the bills to get them through. And that's where you really run into problems, because even if you can get all the Democrats on board for more spending, if you start having to add in things like tax hikes or other types of revenue raisers, you may not even get to that 50 vote threshold. So we're still a little pessimistic on that front. it's worth noting equities seemed a little bit more aligned with our view. They really didn't respond, as strongly as rates. So we'll see how things kind of pan out over the next few days. But if that move continues to stall, we would be looking to fade here pretty soon.
Okay, so even if we don't think that this necessarily means heavier stimulus in a baseline recovery, surely it means that there'll still be a higher likelihood of support if the recovery is slower than we're expecting, or COVID trends pan out worse than we're expecting over the coming few weeks and months.
Yeah, I mean, I do think that's probably the one way you do get to more stimulus is if things get a lot worse. But from an economic or market standpoint, is that really is that a big risk on? If things have to get much worse on the economic front to see more stimulus, that would seem to me to some degree to net out. I think what most people had really been, and I think what rates markets are really reacting to, is that we're going to get stimulus even if the recovery continues on track. That regardless of what happens with this current outbreak, we're still going to see, the $2,000 checks that Biden has talked about, or some other measures of spending, even as that recovery is continuing. So that's what I think markets have really reacted to. But yes, it does, I think, probably take a little bit of the downside risk of worsening of the current outbreak away.
Okay, sticking with politics for now, but switching gears to the UK, because since we last recorded our Bondcast, we now have a long-awaited Brexit deal in the UK. So, Theo, can you just update us quickly on what you think this deal means for markets, and what your kind of outlook is from here now that that sort of tail risk scenario of a no deal Brexit, is behind us?
Yeah, I think it is a game changer for the market. It is very important. We've got a deal, and the market had to price the probability of no deal, and the market had to trade inflation expensive at the front of the curve. So the market was pretty much scared. Will there be a no deal? Will inflation spike up? What will happen? Will we have tariffs, non-tariff barriers, et cetera, et cetera? But this is now being priced out. And this is significant because in the inflation market, we talk about cheaper valuations as those fears have to meet realistic expectations. And in reality, inflation may not prove to be as high as the market expects. So this is significant. The deal and Brexit and politics, they are a lot more significant for inflation than they are for conventional rates. For conventional rates, there are still some discussions with regards to lower rates. So this is something that cannot be excluded, and QE is ongoing. So we don't necessarily have a direct signal on what to do with rates. Therefore, I think that this is a theme which should make all investors, especially the inflation investors, more relieved. But at the same time, those who are on the rate side, they probably will need to focus on other things such as COVID and the comments that we get and the actions that we see both from the government and the Bank of England. So this is really the overview, and this is what I see in terms of politics and how it plays out for the market.
Okay. So now in Europe, Giles, I guess actually for once the political calendar seems fairly quiet as we look ahead to 2021. But where I guess will be the most important event is the German elections closer towards the end of the year. But ahead of that, we have the CDU leadership election next week, which will be, very important given they're the party that's currently leading the polls and likely to be, as it looks at the moment, in the next government. So what are our updated thoughts on that and what it means for, the direction of fiscal policy, given that's been a big call of ours heading into 2021?
Yeah, I mean, it's really striking that nobody's talking about this, at least not in the English-speaking world, as far as I can tell. And it's super important. And this is really this is the precursor, I suppose. This is what's going to set the scene for the way that people talk about the German elections, which, by the way, is supposed to be end of September. For the rest of the year. And it's a turning point year. It's a pivotal year in German politics. And of course, Europe is largely guided by what Germany wants, and that includes fiscal policy. So yeah, it's super important. I'm not sure how much else I can say other than that it's important, because we know three of the main candidates, but we were just checking through the CDU statutes this morning, Imogen and I, and it turns out that effectively the candidates, it's pretty fluid. I mean, they can be proposed right up until the last moment, including during the process in the party congress. And I think, at least for us, the visibility is pretty low on which way that might go. And clearly, I think that the expectation in markets is that we'll end up with someone probably reasonably centrist, and I mean, we'll just take it from there. But that's not necessarily the case. It's definitely possible, for example, that someone with a little bit more of a conservative right-wing bias does end up trying to bring the party back to pre-Merkel settings, I suppose, and that might end up driving a full-scale sort of reconfiguration of the right of the spectrum. So yeah, I mean, at the moment the CDU is polling really well, but that's partly pandemic related, it's partly Merkel related, and it's not clear at all that will be sustained into September. So it's all to play for, and yeah, this will be a major market theme. We'll probably be talking quite a bit about that this year.
Okay, so definitely something to watch over the next week then. The other major market theme, well, which is related, and we've just talked about it a lot, but is, I guess, the still expansive fiscal policy that we see in Europe this year. And obviously that means still a fair amount of government bond supply to come. We know that traditionally issuers like to front load in January, and we don't expect this year to be any different. I think we ran the numbers earlier this week, and we expect around 130 billion of sovereign issuance in January alone this year. How do we think the market will digest that? I know we clearly have the ECB coming back and doing their QE purchases. Do we think this is going to be a problem, or do we think that the market will easily be able to take down the remaining supply?
Yeah, I maybe just start answering that by saying that I was looking through trades that were recommended by our sales and trading recently in a circular email here, and I won't talk about the details of that, but I was quite struck by just how many of those were basically motivated by the front loading of supply. It's clear majority of those trades. For us, I think that the simple thing to say is that the total sort of net supply that's going to be pushed into the market after the ECB takes its share is going to be around 50 billion less, roughly speaking, than last year, once you consider corporates and everything. And so a priori, there's not really going to be a problem, particularly if people are, if there's an underlying bid that's pretty strong because people are worried about COVID trends and so on. And I think they probably will be. The concern, I suppose, if there is one, is that there wasn't necessarily a particularly strong effort being made by investors or dealers to kind of create space, to set up short for supply, just to make sure that everything goes off well in the first part of this year. I think there's probably an assumption that there wouldn't be very much of a concession to take advantage of, and in any case the ECB would just be there in size to smooth out everything. So far, what can you say? I mean, listen, we've had a very strong reception in credit. That's pretty obvious. We had another 100 billion book for the Italy syndication in the first week of the year. There's clearly very, very strong demand. I would say we would expect the demand to be strongest for anything that's kind of got some spread in it. I don't think that the markets are going to be quite as enthusiastic about core fixed income around about these levels, and actually we are a little bit higher. Yes, in sympathy with the US, but I think that is also a reflection of the kind of overvaluation in European fixed income. At least that's our perspective on it.
Okay, thanks, Giles. And Theo, I know that the supply story in the UK is something that you've been talking about over the last few days, as well as a big theme for the coming weeks. I suppose with this Brexit hurdle now cleared to a certain extent, does that pave the way for a lot of kind of investor demand to take down this net supply that we're going to see over the next few weeks, or are you more concerned there as well?
I think that right now we're entering a phase where net issuance, so basically the difference between what is being issued and what is being absorbed by the BOE, so that net issuance will be again positive, so it will rise again. This is big news because we had almost one whole month of negative net issuance. Now this means that the market will need to cheapen. The other point is that this additional issuance will come at a time of expensive valuations across gilts. So what I do expect is investors to be looking at the UK market as a way to express bearish positions, given that valuations are expensive, especially versus the US, for example.
Okay, so just to complete the picture, I guess, Blake, does the election news this week and the Democrats win in Georgia change your view of what this means, I guess, for the debt ceiling and for bill supply in the US?
No, and I mean, to kind of follow on what these guys were saying, I mean, we have a similar situation in the US where, I think supply is actually going to be a bigger story this year than it was last year, despite everybody, talking about it pretty heavily last year due to the fact that Treasury was kind of very aggressively ramping up auction sizes. But kind of when you look at the numbers of what issuance is going to be this year, we have coupon auctions basically staying flat throughout the year, and those increases have stopped. But what you're left with is a run rate that is much higher than it was last year. And at the same time, we have the Fed continuing to purchase throughout the end of this year is our expectation. But that's still a lot smaller than what they were buying last year. If you remember, in March and April, they came out and were kind of hitting the market every single day in very, very large size, wiped out a huge amount of supply for the market. So this year is actually going to be a bigger year in our minds for coupon takedown. And I separate that out because, as you mentioned, debt ceiling is going to be a huge deal in the middle of the year for bill supply. So the front end is going to see some really drastic dynamics in my mind due to the reinstatement of the debt ceiling. And I don't want to get into all the mechanics of how that works here, but the way the laws are written essentially say that Treasury has to get their cash balance down to 130 billion by July 31st. Right now, they're sitting on about 1.6 trillion in cash. So getting from 1.6 trillion all the way down to 130 billion, while the coupon auction, again, as I just mentioned, the coupon auction is still raising all of this new cash. They don't want to touch that. So they not only have to offset the cash that's being raised on the coupon side, they also have to pull down this 1.6 trillion. So, obviously the stimulus package that was just passed, that spending will help move some of this cash off of their balance sheet. But in the end, they're going to have to cut bills. I have about 1.3 trillion in bill cuts into the middle of the year. That's a historic cut in bills. We've never seen anything of that magnitude in U.S. history. I mean, this is a really significant move. As you mentioned, Georgia elections may have changed the dynamics there. With Democrats holding all the levers here in government, there is the possibility that we get an earlier deal on the debt ceiling, or they sign some kind of deal that staves off that reinstatement date for a period of time. But I just don't see it as likely. When we look at all the past debt ceiling issues that we've had in the US, the real impetus for Congress to get their gear, to get their process together and get something signed is usually the date when Treasury's about to run out of cash, which, I separate out the reinstatement date for debt ceiling. This is when the debt ceiling goes back into effect. And then there's a later date when they actually can't raise any more money, they're out of cash, and the US risks a default. That's usually the date when we see Congress come together and pass a deal. And I think that's still going to be the dynamic here, even with Democrats holding all the houses, that they're really not going to do some kind of deal until they risk a default. So that means this big pay down that I'm expecting is likely to still happen. So I think that on the supply front, that's really going to be the big theme that we're all kind of watching. Of course, like if they do come together and sign something early, that'd be a very positive surprise for markets and avoid a lot of pain. But I'm not there.
Okay, that makes sense. Well, thanks, Blake, and thanks to Theo and Giles as well. It seems like we've got a lot of themes to already be thinking about for the start of this year, and it already looks like it's shaping up to be a very interesting one. So we will catch up on all of those themes and probably more next week. Thanks. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.